Hello everyone and welcome to the 2018 CPA PEP and CFE Curriculum Update. This is a very important session. It's not a very long session, but it's a very important session. And the real purpose of it is to help you understand all of the curriculum updates that you're responsible for over the next little while, over the next, say, 9 months or so from here. So everything that we will be talking about will be applicable all the way up until December of 2018. Okay, so I'm going to cover a lot of different information here, and the purpose of this webinar really is to capture some of the biggest curriculum changes in their entirety from start to finish on everything that you're responsible for. Before we get started, I'm just going to do a quick sound check and quick video check. If you can hear me, please do let me know. Feel free to say hello in the chat box on the right side of your screen or at the bottom, depending on how you have your window resized. But if you can hear me, if you can hear and see, please let me know. Okay, I won't begin presenting until most people are able to follow along. Okay, perfect. I'm just going to quickly type this out. So if you are not able, if for some reason you are not able, if you're not able to see, please refresh and try to use Google Chrome. Okay, if you're unable to hear or see, please refresh and try to use Google Chrome. It looks like the majority of people are able to hear me, which is great. So I'm going to get started. Welcome to the 2018 CPA PEP and CFE Curriculum Update. This is a really important session. There's a quick webinar disclaimer that I'd like to just quickly bring your attention to. You can read it in your own time. I'm your session leader for today. This is Mike Katsevman. I'm the course director at PrepFormula. Previously, I was a National Center marker for CPA Canada. I was an independent contractor. Also used to be part of York University's Atkinson program and with my old firm, E&Y. So I've had a lot of extensive experience marking professionally, teaching, etc. For the CPA bodies across Canada and have marked the exams professionally. The purpose of this session is to bring you up to speed on all the curriculum updates. So I'll explain what we're going to do. The timing of this session will probably be approximately 45 minutes to an hour. I think that's kind of the end, and I've left some time for questions. So you'll see that the webinar is scheduled for about an hour and a half. I don't anticipate that I'll take the full hour and a half. So if you have any questions at all, please do let me know. Feel free to communicate with me throughout the chat, a function at the bottom or on the side of your screen, and I will pause and answer, and I'd be happy to, help answer any questions that you may have about these standards. Please note that these are very complicated changes, and for 2018, you're all pretty lucky. Well, not quite, but these changes are pretty significant. So it's not like these are minor changes. These are major, major, major changes, and these will be on your exam. So for the past 5 years or so, there haven't really been any major changes. This is the year where there is a lot of new stuff, so we're going to cover that. So let me explain how I've kind of divided up this webinar. The first portion will be standards which you need to know and should spend time on. Basically, standards you should care about, okay? Then we're going to transition about things that CPA Canada believes you should have some working knowledge over. So I call those standards that you kind of need to know and should not spend time on, okay? But for now, let's start with the following. And also at the end of the session, I'm going to talk about elective roles. A lot of people have been emailing me and have been asking, in general, what electives should I take? Whether it's a part of CPA PEP, many of you may know that you have a choice between 4 electives, assurance, performance management, finance, and tax. And what I'm going to do is discuss role choices, and I'll also give you some working data for you to work with so you have a clear understanding of what role choice you would want to take at that point. So really what I mean by this is I'm going to show you real pass rates from all 4 roles so you can make an informed decision whether it's for CPA PEP or for the 2018 CFE, so you have a clear understanding, okay? I'm going to give you real pass rates so you can make your own decision about which role you think you should take. Now, with that information, when I'm going to be providing you with these real pass rates, please note that this is just random information, okay? I'm throwing as much information as possible that I have at my disposal at you. The reason why I'm doing this is I'm a firm believer that more data means better decisions. But this doesn't mean that you should immediately go and say, yeah, the highest pass rate is in the following elective, I'm going to take it, right? You should also consider your own skill set and see exactly what you believe that you're comfortable with and what you're not comfortable with. So for example, if finance happens to have the largest pass rate, it doesn't. But I'm just saying, if finance has the highest pass rate, this doesn't mean that all of you all of a sudden should be getting into finance as your elective. That would not be something that would help a lot of people. Okay, so I'm going to show you data. So again, there's a few people that have just recently joined us. Welcome. And the way that this webinar, again, will run, we will look at standards which you need to know and should spend time on. Then I'm going to kind of talk about standards that you kind of need to know and should not spend time on, okay? And then we'll talk about elective role choices. All right, pretty simple. I hope to have you out of here in about 45 minutes tops, okay? So really compressed, really good information, really clear, straight to the point answers. So you'll probably have everything that you kind of need to know, okay? Just before we get started, I just want to ask a quick question from the group. Okay, so my question is, where are you at in the process currently? So where are you at in the process currently? Are you just starting, for example, starting in CPA PEP, writing a specific module exam, writing 2018 CFE? Where are you currently at within the process? Please state your answer in the live chat. I just want to get a feel from the room. I want to get an understanding of where people are at generally. Okay, great. So lots of Capstone 1 and CFE writers. I anticipated that a lot of people who would pay attention to this webinar would be in specifically doing a 2018 CFE. By the way, these aren't the only people that should be here. And yes, I'm already seeing, for those of you that are watching this as a replay, right away, I'm already seeing some Core 2 people. And again, this will also affect you, right? This will also affect you. This will be really important for you either way. Okay, perfect. So it looks like I would say the majority of people here so far that have provided an answer through the chat box are actually 2018 CFE students that are going into Capstone 1. Perfect. Okay, great. I do appreciate all of you providing in and kind of writing in where you're at as part of the process. It just helps me tailor the presentation a little bit more. But just to let you know, for anyone who is in the 2018 CFE, and if you're planning on doing the CFE, or even if you're in the elective stage, this will affect you. Everything that I'm going to talk about will be extremely important for you to understand, and these are major changes. So with that in mind, let's get started. So in general, for 2018 CPA PEP, module exams and the CFE, you are responsible for the following legislation. So these are standards which you must know. There's no way around them. And when I say must know, it means that you are not able to use the previous standard and pass. If you use the previous standard or any information or any wording from the previous standard, you will not be successful. So CPA Canada released a statement saying that if you use the old standards that I'm not covering here, you will not be successful. So again, this is really, really important. What I'm going to do, especially for the first standard, which will be IFRS 15 revenue, I've actually set up a really nice chart, and when I was putting together this webinar, I was trying to think of you. What would I want, if I was in your shoes? I would want a clear chart describing the differences between, IAS 18, which was the previous standard under IFRS, and IFRS 15. Okay, so I've put this together for you. So you'll have a clear chart explaining what some of the key differences are, that if you are familiar with IAS 18, you'll see the language differences. Okay. Also, you are responsible for assurance standard changes with an effective date of December 31, 2017. Which basically I'll talk about a little bit more of, but why don't we just kind of get started? Lastly, you are responsible for tax legislation substantially enacted up to November 30th. And by the way, it's not quite November 30th because there was a new bill called Bill C-63 that was enacted. And I'm going to talk about what that bill, basically made clear. Just to let you know, there was a budget that just came out a few days ago on the 27th of February, and it solidified some of these measures that I'm going to talk about. So a lot of what I'm going to talk about is something that you will be tested on, okay? And from a tax perspective, we're going to cover 4 major changes: personal income tax measures, business income tax measures, private corporation tax, and sales and excise tax measures, okay? One small caveat: you are not responsible for HST or for provincial tax on your general exams. But what I found really interesting is the excise tax measures that were brought in are extremely interesting, and they target a potential scenario that I think is highly examinable. So I'll cover those in a second. But again, normally, only the GST portion, right? The federal portion is tested. But again, the reason why I like this so much is they're bringing in a new rule, which essentially is something that I believe could be, very likely to be tested. And I'll talk about this in a second. So let's first start with IFRS 15. Now, there's lots of information online about IFRS 15. Most of the big 4 firms, they are publishing their own guides and documents. And, we have lots and lots of notes on IFRS 15. And pretty much everywhere I look, I seem to be bombarded with IFRS 15 information. In general, I think that's a good thing. The reason why that's a good thing is there's so many resources out there. But what I'd like to do is clean it up and make it extremely easy to understand. If you read a lot of the official guidance from CPA Canada, if you try to read this in the handbook, there's no comparison tables. There's no comparative features. And, this is sort of the way that I learn. I like to compare and understand using a baseline. So I want to do the same thing for you here. So as an overview, revenue affects everything within your professional careers. Every single business generally has revenue, okay? And it's a fundamental part of operations. So when you hear that revenue changes and the revenue standard changes and changes significantly from an IFRS context, you really have to pay attention. From an exam perspective, this affects annual reporting periods on or after January 1st, 2018. When you're first applying IFRS 15, you should apply the standard in full. So basically, you can, try to apply it to the best of your ability, including any retrospective application to all contracts that were not yet complete at the beginning of that period. So in other words, you can't keep some of your old contracts under IAS 18. You have to convert them retrospectively. Here's the chart that I wanted to show. So I couldn't find this, so I built one for you. So if you remember, IAS 18 looked at revenue recognition timing based on, what we called risks and rewards. Well, that's gone. Those words, risks and rewards, they're gone. They still, by the way, are part of ASPE. So the confusing part here is you're still responsible for those words, but they remain with the ASPE side of things. Now, IFRS 15 now looks at timing being focused on the control of the goods being transferred. So, we really are talking about now a very definitive point. As you can see, IAS 18 talks about transfer of risks and rewards, and it leaves it hanging in the air that, whatever you feel like that transfer point is, it's up to you to establish what that might be. IFRS 15 says, no, we're not going to look at, in general, risks and rewards. That's fluffy. We're going to talk about control over the goods. Okay, number 2, allocation of revenue could use either the residual approach or the standalone selling price method. That's also gone, okay? Allocation of revenue would be based on the standalone selling method, and only in extreme cases can we use the residual approach, okay? So the residual approach takes a back seat. It's completely out. Also, significant room for judgment with respect to certain areas. So IAS 18 kind of said, well, there's no specific guidance on revenue recognition for things like warranties or contract modifications, and we had no prescriptive explanations on how to apply this. Instead, because of IAS 18 being incomplete, they kept on adding, the professional accounting bodies kept on adding in something called IFRS, which are additional interpretations to try to help explain some of these major revenue type linked areas. IFRS 15 again tries to be more prescriptive. There's detailed guidance for revenue recognition for both warranties and contract modifications. Okay, so there's more examples. In general, IFRS 15 follows a 5-step format. The first step is you identify the contract with the customer. Second, you determine the transaction price. Third, you recognize the revenue when the entity satisfies a performance obligation. Number 4, you allocate the transaction price to the financial obligations in the contract. And number 5, you identify the performance obligations in the contract itself. So let's talk about a few key definitions, which again, you really have to understand. Contract, you really mean an agreement between two people that creates an enforceable right and obligation. Okay, contract doesn't have to be written. It just has to be enforceable in nature. Okay, so somehow enforceable. That could be something else. Performance obligation, a promise in a contract with a customer to transfer to the customer either a good or service that is distinct or a series of distinct goods or services that are substantially the same, that have the same pattern of transfer to the customer. Okay, pretty simple. And the standalone selling price, right? So there's no more, again, residual approach, right? The standalone selling price is the price at which the entity would sell a promised goods or service separately to a customer. So if there's a bundled deal with multiple components, then a standalone selling price is almost like the fair value, right? It's the fair value of it being sold individually. That's what we have to know. Let's apply this with a few examples with some more information. Step 1, identify the contract. So a contract, is only a contract with a customer if it meets the following 5 points. First of all, the contract is approved by the parties to the contract. Okay, so both people have to agree. Okay, if they don't agree, then there's no contract. Okay, each party's rights in relation to the goods or services to be transferred can be identified. So you can actually identify what they're bringing to the table. Okay, number 3, payment terms for the goods and services to be transferred can be identified. So hopefully, you've set a price, you've set when it will, be paid. Number 4, often a very confusing term for a lot of people. This says contract has commercial substance. Commercial substance sounds different than what it means. Commercial substance really means that there's a change in cash flows, okay? After you exchange, say, the money for the goods. So is there a change in cash flows? Let me explain it in a very logical way. if you buy a good, let's say if you buy a machine and you want to use that machine, you paid cash for the machine. Okay, you buy the machine and you're going to manufacture t-shirts with that machine. Your cash flows will change because all of a sudden you acquired a machine that can now generate new cash flows. AKA, there is commercial substance. Okay, very simple example. If cash flows change, then there is commercial substance. And number 5, it is probable that the consideration to which the entity is entitled to in exchange for the goods and services will be collected. So again, collectability is obviously huge. If you enter into an agreement with somebody who you think is never going to pay you, then obviously that's not going to work. Number 2, identify the performance obligation in the contract. So when you first start the contract, you should first assess whether you've been, promised the right goods or services and identify that as a performance obligation, right? So this could be a good or service and figure out, what is this? Like it has to be distinct, right? You have to get a clear understanding of what it might be. This could also be a series of distinct goods and services that are substantially the same, that have the same pattern of transfer to the customer. Okay, a good or service is distinct if both of the following are met. Number 1, customer can benefit from good or service on its own or in conjunction with other readily available resources. So what does readily available resources mean? So, benefiting from a good, that makes obvious, that makes a lot of sense, right? So I bought this, machine for printing t-shirts, great, right? I can benefit from it. If we have to do something to it, if we have to build something, if we have to modify something, if we have to, use readily available resources, and then we can benefit from it, then that's totally okay too. It doesn't mean that it's not acceptable, right? It doesn't mean that the seller is, is going to be punished, right? So just be careful, right? It could be a part of like a chain of a work in progress type of a thing. The entity's promise to transfer the good or service to the customer is separately identifiable from other promises. So it has to be a separate promise. It has to be like a payment, right? And a contract for that individual asset. Number 3, transaction price. So, this might sound kind of obvious, and in most deals, the transaction price is straightforward, right? It's the amount which an entity expects to be entitled in exchange of this transfer of goods and services. So this is the amount that you will receive. Now, an entity will need to consider customary business practices when assessing this amount. What does that mean? So, for example, if you're normally in the business of selling heavy machinery, well, maybe normally people don't pay the full transaction price. People maybe haggle you, right? You have to understand and take things from a context of business practices when assessing the transaction price. Okay, so if nobody ever pays you the full retail on something, well, maybe that's not the true transaction price. Maybe it's something different, right? So that's just a very simple example. Also, variable consideration included in the transaction price if for some reason there's some sort of a variable or an expectation of a future event, a future rebate, or a promise of a refund, a promise of a penalty, which is like a reverse refund. Okay, if there's something that is something expected, then you have to account for it, right? Also, sales or usage-based royalty generally would be recognized only when you sell it. So, for example, lots and lots of music companies sell music on a royalty basis. They will license their music to a radio station, and when the radio station plays it, right, when they use the song, then they will pay the royalty fee. Number 4, you allocate the transaction price to the performance obligations in the contract. So when a contract has multiple performance obligations, by the way, this was previously called multiple deliverables. If anyone's kind of remembers that term, very similar to this. It's just that this has been made now a part of one of the steps. Okay, An entity will allocate the transaction price to the performance obligations in the contract by reference to their respective and relative standalone fair value prices. Okay, so you have to kind of use the prices. Now, if the standalone prices are not directly observable, the entity will need to estimate, whatever they might be. And IFRS 15 actually provides you with ways that you can estimate and do this job. Okay, you can look at the adjusted market assessment approach, the expected cost plus margin approach, or the residual approach, which generally is not really, permissible. And there's a lot of rules behind it, but, kind of take a look at more of that. Okay, I'm going to actually show an example here in a second. So someone's saying like phone contracts, and that's exactly it. Most of you probably have entered into a multiple performance obligation contract. And it's, your cell phone contract is probably, a very clear example of this. Also, if you, for example, if you're releasing a vehicle or purchasing a vehicle, it's the same thing. Somebody owes you something. Somebody owes you a warranty, a service, right? During the duration of when you're driving it for the first 4 or 5 years. Okay, so there is an expectation somewhere there. Okay, and also any financing arrangements. As a practical expedient, generally speaking, we expect that this good will be paid off in less than 12 months. If it's not, then we may want to reconsider whether this is truly revenue or not. Let me give you a few examples here. So the first example is a grocery store. Okay, so you walk in, you buy an apple. That's a simple transaction. There's no allocation. There's no adjustment, right? So you pay me 50 cents, you pick up the apple, you walk away. It's not like I give you a warranty. The apple will be good for 4 years. And only after, 4 years, I will, anyway, simple transaction, right? So simple transaction, there's no allocation, there's no adjustment. 50 cents is 50 cents, okay? So from that context, that's a very simple example. Now, let's say that you walk into a clothing store, example 2. An item has a purchase price of $100. Let's say that you're buying a really fancy pair of jeans. And you say, okay, well, the price is $100, but the store gives me a right of return policy. Okay? Now, basically, the way that right of return is dealt with, that would be an adjustment to the selling price. Under IFRS 15, we'll say, what is the expected likelihood that any person buying these jeans will return them? And let's say it's 5%. At that point, variable consideration is $5. Therefore, there's 2 performance obligations. One is the initial sale, the other is the return. Therefore, we set it up as 95 and 5. Okay? Very, very simple here. Okay, example number 3. Sorry, someone's experiencing issues with their connection. I don't think that there's any issues with the connection from my end. My connection appears to be very steady. So let me know if you're experiencing issues. Is anyone else seeing connection issues? That must be a local problem. I don't believe that other people have this because my screen is showing as active. Can anyone confirm whether they are able to see? Are people able to follow along here? Just want to know if there's a connection issue now or not. Okay, perfect, great. Okay, so the third example, yes, so someone's asking, what do you do in example 2? And yes, basically, you would recognize that $95. Now, example 3 is someone who, previously just said, and we're describing this like bundled transaction, okay? So let's say that this is a mobile phone retailer. There's a bundled transaction for 2 years of network service, $40 a year, plus a free phone. Normally, the price of it is $95, okay? This is a really cheap network service for $40 a year. But let's just, for simplicity, say that this is, the numbers that we're talking about. Sadly, in our society, this, you could probably add a 0 to the end of all these numbers and they will still be relevant. But anyway, a whole other story. So the total bundle is worth $40 plus $40, right, per year, 2 years, plus $95 for a total price of $175. Now, assume that the customer only pays $100 for all of this. Okay, so you come in and say the value of the bundle sold separately is $175, right? At that point, the customer only pays you $100 because you've got some kind of expectation. There's really two performance obligations here. One is the initial setup plus the network fee, right? And at that point, you would allocate the revenue proportionally based on the relative value of the phone and network service. So $54 would go directly to the phone, and then each individual year will be billed at $23 per year. Okay? That's the way that this would be done under IFRS 15. Just to let you know. So as you can see here, IFRS 15 makes it really easy to proportionately describe and allocate values based on the relative fair value, more so than IAS 18. In my opinion, this is a breath of fresh air because it's so clear and so easy to apply to any other, type of transaction without any significant clout, right? Without any significant doubt around how you would apply it. So I think it's very straightforward. So after we, finish with step 4, we go to step 5, where we recognize revenue when the entity satisfies a performance obligation. So revenue is recognized as a control. As control is passed or either over time or at a point in time. The control of the asset is defined as the ability to directly use and obtain substantially all the remaining benefits from the asset. Okay, so as soon as we, have the final control, at that point we actually record the revenue and then we proceed. So this includes the ability to prevent others from directing the use of and obtaining the benefits from the asset. The benefits related to the asset are the potential cash flows, right, which may be obtained directly or indirectly. How does this impact your organization? So how does this impact any case? Number one, it's a presentation in financial statements. So any contracts with customers will be presented in the entity's statement of financial position as a contract liability and a contract asset or a receivable, depending on the relationship. Any contract liability at that point, that would be a customer basically paying something prior to the entity performing or transferring the related good. Until that point, it would be very similar to that. Daniel asks a question. Isn't the return example similar to creating an allowance? Yes. An allowance is a concept that was used for a very long time, both under ASPE and IFRS. This just further defines that we actually have to use a fair value as part of the overall calculation. For anyone who's asking why was the amount $23, there was a formula that was provided. So, you can go back and you can kind of check it out and see why it was calculated that way, right? So this is how you get to $23. It's the proportionate value. Disclosures. So there is a disclosure objective in IFRS 15. It's for an entity to disclose sufficient information to enable users of financial statements to understand the nature, amount, timing, and uncertainty of cash flows. Basically, you have to explain, right? And therefore, an entity has to disclose qualitative and quantitative information about all of the following. Number one, all its contracts with customers, any significant judgments and changes in judgments, okay? Or any assets recognized from the cost to obtain or fulfill a contract with customers. Now, if you look at the standard itself, and furthermore, as part of our courses, we're going to cover more of IFRS 15, which does provide a lot of information and further guidance on the following things. Okay, so if you look at the actual standard, there's more information, and we are going to cover this in the program at a later point. But just to let you know, we don't have time to go through the entire standard front to back, but there is guidance on all of these principles. Okay? Key takeaway, extremely complex standard. Okay? You really have to make sure you understand the basic rules. And remember to list all your revenue streams and prepare an analysis using the 5-step model for each revenue stream. That's how you max out your potential marks on an exam. Okay, any questions about IFRS 15 before we move to IFRS 9? Any other questions? Any other questions? I'll give it about 10 more seconds. Was that simple enough? I tried to make the standard very simple because IFRS 15 appears to be really complicated, but I don't think it needs to be. I think the standard is pretty difficult, but kind of, for someone who's asking, sorry, I'm late, but does the IFRS 15 apply to 2018 CFE? Yes, and I highly encourage you to watch the webinar from the beginning because it does apply. Do the terminologies change for journal entries? Yes, they do. But we're not going to cover all your journal entries here. In fact, most CFE cases and, say even like a Core 1 exam wouldn't ask you to provide. Would you have an example that doesn't include both fair values? Not as part of this webinar. So definitely not something that we're going to cover today. So unfortunately, possibly at a later date. Yes. How does long-term construction in progress revenue will be affected? That's a really good question. So you have to apply this standard retrospectively. So you have to go backwards and actually apply the standard to when you first originally got the contract and then go through the 5 steps. So I don't really know exactly how it would apply to the specific situation that you're thinking about, but you would have to apply the 5 steps retrospectively. Daniel, for case analysis, do all 5 criteria, the 5 steps have to be applied depending on case facts? Yeah, Daniel, let me explain it very clearly. I think you should always list your revenue streams, okay, whatever they are, and then for each revenue stream, you prepare an analysis with the 5 steps, okay? So the way that you apply IFRS 15 is list all the revenue streams and then prepare the 5 steps for each revenue stream. It's really important. Someone's asking me, well, actually, that's not really a question. Disclosures is for contract assets or liabilities. No, disclosures is for IFRS 15 in general. Right? So disclosures is found here. All the contracts with customers, all significant judgments, any assets recognized. So assets and contract assets is one of the disclosure requirements. The other 2 disclosure requirements are a listing of all contracts and any significant judgments. And someone's asking, do the same for service contract? Yes. So any contract, any type of revenue. So again, service, good, any kind of revenue, anything under the sun, long-term contract, short-term contract, list all the revenue streams, and then prepare the analysis and apply the 5 steps. That's how you do well in IFRS 15. Okay, from a studying perspective, prior cases for IFRS use IS 18. Will there be some cases available via PrepFormula that we can practice at the new standards? Absolutely. That's in the works currently and will be available shortly. Not a problem. Okay, perfect. Alrighty. Let me just kind of go to the next portion here. IFRS 9. So this was the big standard before, right? IFRS 15. IFRS 9, we actually have a webinar coming up on IFRS 9, so I won't spend a ton of time here. I'll just kind of give you some high-level comments, and we'll talk more in the actual IFRS 9 webinar coming up. Okay, so again, quick overview. This focuses on the financial reporting of financial assets and financial liabilities that will present useful and relevant information to your stakeholder users. The effective date is the same, okay? It's the same for any periods beginning on or after the 1st of January 2018. And when you're first applying IFRS 9, entities should apply the standard in full for the current period and then again, retrospectively. Okay. Let's talk about initial measurement of financial instruments. So all financial instruments are initially measured at fair value under IFRS 9. Okay, now it's fair value, but the standard later on talks about transaction costs. So if there's any transaction costs, then that would be deemed to be something that would, be subtracted from fair value. So assume that you buy a financial instrument for $100, but there's a 5% transaction fee, aka $5. The real fair value is $95. Okay? So when we initially record it, we don't put it at 100, we'll actually write it down to 95. Any subsequent measurement, once you're holding this financial asset, IFRS 9 divides all financial assets that are currently in the scope of IAS 39 into two classifications. One amortized at cost and those measured at fair value. Okay, if you record at fair value, you have a choice. Okay, you have a choice, and by the way, this is something that's new. You have a choice to either record entirely in your profit or loss, or record in other comprehensive income. If you look at the standard in the handbook, you'll see that they use these extremely long, confusing acronyms: FVTPL. It took me a while. FVTOCI. And I was looking at this and I was thinking, like, why in the world would you use an acronym? The concept of an acronym means that it's short by definition. This is not a short acronym. Anyway, but the point is, when you're subsequently measuring financial assets, if you have used the fair value model, okay, originally, and you're constantly, moving it forward at fair value, there's going to be fluctuations to your assets. You record those gains and losses, those fluctuations, either choice in your P&L, known as the, FVTPL route, or FVTOCI route, other comprehensive income. A quick little tidbit here. There is no OCI under ASPE, okay? So that's just to kind of bridge the gap here. Now, there's some more information about debt instruments, like a bond. If you pick the fair value option for debt instruments, the OCI classification is mandatory unless the fair value option is elected. Okay, so in general, you go after the OCI route and not really, the fair value route. And you can do this assuming that you meet this test. You meet the business model test, where the objective of the entity's business model is to hold the financial asset and collect the contractual cash flows rather than to make like quick gains, okay? And the cash flow characteristics test, where the contractual terms of the financial assets give rise on specified dates to cash flows that are solely payments of principal and interest on the principal amount outstanding, okay? Cash flow characteristics test sounds more like a bond or like a loan repayment type of a thing. Okay, even if the instrument meets the two requirements to be measured at amortized costs or using the OCI method, right? IFRS 9 contains an option to designate at the initial recognition a financial asset measured at the regular P&L method, right? Where you're recording in P&L, and basically it allows you to originally record the investment in such a way that it's constantly using one standard throughout the entire process. If it's an equity instrument, okay, all equity instruments in the scope of IFRS 9 are measured at fair value in the statement of financial position with value recognized in P&L. Okay, and for any equity instruments where you have elected to present the fair value changes in in your OCI balance, those ones would be separately identifiable. But just to let you know, IFRS 9 is very complex. We're going to cover it on March 5th. Okay. Any questions on IFRS 9 up until this point? Pramit asks, is reclassification from the P&L method to the OCI method, is it permitted? The reclassification is permitted, but it has to be done across the entire class. And we're going to talk about that more again on March 5th. But, you know, I think we're kind of moving more into the deep end territory here. Okay, perfect. So let's talk about a few tax measures. Let's talk first about tax measures that you have to know. There's a few new disability tax credits. Okay, addition of nurse practitioners to medical practitioners to now certify impairments. There's new eligible medical expenses. So certain individuals who require medical intervention in order to conceive a child are able to claim the same expenses. Okay, so these are basically people who would use like in vitro fertilization or something along those lines. There's currently 3 different caregiver amounts, and they're called the caregiver amount credit, the infirm dependent amount, and the family caregiver amount credit. And the budget replaces all of those with a new line called the Canada Caregiver Credit. Any public transit tax credits are eliminated. Any home relocation loan deductions are also eliminated for benefits arising in the 2018 and later tax years. Okay, so if your employer asks you to relocate somewhere, gone. Okay, tuition tax credit. Now things become really muddy here. Eligibility criteria for tuition tax credits to fees for an individual's tuition paid to a university, college, or other post-secondary institution in Canada for occupation skill courses that are not at the post-secondary level. The credit would only be available to these in these circumstances if the course is taken for the purpose to providing the individual with skills in the occupation and the individual has attained the age of 16. Now, please keep in mind this is federally. The tuition tax credit still applies provincially in most provinces. It looks like the feds can't really agree with the provincial government. A few other little things. Registered Education Savings Plans, RESPs. They're going to be more consistent with the same rules. Basically, there's new prohibited investment rules. If you look closer into this might make a lot of sense why they're doing this. For example, an RESP is something that you create for one of your children, if you have children, and you can contribute to money that grows tax-free, and the government also provides you with free money. Okay, it's free money. It's wonderful. If you have kids, you should really do this. And all of this grows tax-free up to a certain limit a year. Basically, there's new investment rule, there's new investment rules that you can't basically invest in anything that is related to you. Okay, so you can't invest in yourself with your child's RESP, which is already in place for RRSPs, but was sort of a loophole under RESPs, which is now closed. Business tax measures. So this is a big one. Build basis accounting for designated professionals. This is eliminated, right? For any taxation year that begins on or after budget day. Transitional measures will also be set up in place. Income sprinkling using private corporations. So this is where you hire your spouse to work in your business on paper to, hopefully use that person's income tax bracket simply for managing your income and paying less tax. That's going to be heavily reduced. And holding a passive investment portfolio inside of a private corporation, which normally would be taxed at a, they're trying to kind of go after that with, it's already taxed at the highest marginal income tax bracket, and they're trying to increase it a little bit more. And, any loopholes around converting a private corporation's regular income to capital gains, there are some changes there too. Okay, the reason why I wanted to mention this one is many of you know that on the CFE, and particularly all the exams, really on the case portion, they like to test things that are very relevant from a day-to-day perspective, So, for example, they've tested condo corporations. They've tested bike sharing services. They've tested medical marijuana type cases. So there's lots of topical issues that come up, and of course, where would you see these cases? You'd see them on your professional exams. So I think that's kind of, really important, and something for you to really kind of wrap your head around. So the reason why I wanted to mention this one change from a, excise tax perspective, and by the way, excise tax is something that you are responsible for at a kind of level B or a level C area, and strictly from something that you kind of just need to be aware of, okay? And generally on the concept of strictly looking at the kind of, the federal portion, which is just GST. Now, there's been a recent restriction that allowed, there used to be a loophole which allowed small taxi operators to not collect HST and GST and not pay it. So for anyone who is an Uber or Lyft driver, and by the way, Lyft is the same thing as Uber, and now I think Toronto is one of the first cities that has Lyft, but it's the same service, okay? So think Uber. It's like a ride-sharing service where you hire somebody. So, your Uber driver would not collect HST, would not remit it. And there is a key change effective July 1st, 2017, that now basically requires Uber drivers to file GST and HST. And they don't qualify as small suppliers. They have to do this. Okay? It's something that I think is really important. So, okay, there's a quick question here before I continue. Please give an example of build basis accounting. Yeah, sure. So build basis accounting should scare you, by the way, or the elimination of. It's often also called work in progress for other industries. So build basis accounting is something that affects doctors, lawyers, professionals, accountants, in general. And there were these prescribed groups, including, by the way, CPAs who used to use this, where you can elect to exclude the value of work in progress in the current year. So, for example, if you have a contract and you haven't really finished it this year, you could exclude it from this year's income. Now, does that make sense? And, the concept of work in progress makes a lot of sense to me. So, on a personal on a personal level, I don't agree with the government doing this because I think it moves away from fair value. And, when all the other standards, in the world are trying to move towards fair value, right? This moves away from fair value because build basis of accounting basically used to allow for, specific designated professionals to elect to exclude certain value for monies that were not collected. Okay. And, usually what they would do is they would recognize only when the work was billed or billable. So it's essentially the work in progress, and they're trying to eliminate this. And there's going to be some sort of a transitional relief program where they're going to elect 50%. This is now getting way above and beyond what you need to know, but they're going to allow basically 50% of the lesser of the cost and fair market value of this work in progress to hit, your return, like in the following year, instead of the full amount. So they're going to allow you to take 50% of, this change and defer it to next year. Okay. Great. Okay, great. So there's a few other standards, and CPA Canada officially released this statement saying that you kind of just need to know these. So let me describe these as standards which you kind of need to know, but don't waste a lot of time on these. So you're still responsible for IFRS 16, although it doesn't quite hit you this year. There's a few standards which you need to know it. Effective date of January 2019, IFRS 16 leases has an awareness level. We'll talk about that. There's also new standards under 4433, tangible capital assets held by not-for-profits, intangible assets, and collections. We're not going to spend time on these because they're not really something which you have to kind of even look at, okay? And there's new special reports that are now going to be updated. Okay, so there's going to be special reports for CSAE 3530 and 3531 starting in 2019, not 2018. Okay, so again, you don't need to know these. You just have to know that these changes are coming. Okay, there's a quick question here. Kui asks a question. Are all ASPE and IFRS sections listed in PrepFormula had been updated to the most recent change? No, they have not. Hence the purpose of this webinar. So these changes just took place, right? These are, there will be changes to the PrepFormula materials all across the board. And we are working hard to get to this point. But, this is very new, right? This is extremely new. Okay, so let me just kind of walk through a few basic features of IFRS 16 that you kind of just need to know. The first is the entity identifies a lease as a contract and recognizes an asset. There's no more operating leases. You measure leases the same way that you do as PP&E going forward under IFRS, and the lease liability at the present value of unpaid lease expenses. Okay, so there's a few exceptions to it, like really short-term leases and low-value assets, but generally speaking, no operating leases. And most importantly, we also talk about new enhanced disclosures to talk about residual value risk. Okay, and this replaces a whole lot of standards. IS 17 is gone, IFRIC 4 is gone, SIC 15 is gone, SIC 27 is gone. Completely all gone. New special report changes. So again, 2019, not this year, not for 2018 CFE, but again, you have to be aware of these. So sections 5815 and 8600, right? Audit reports and review reports of compliance with agreements and statutes and regulations are gone. They're going to be updated to a new session. And there's new requirements with acceptance and continuance and anything valid out for any practitioner's report dated on or after April 1st, 2019. And we're basically at the end of the session. Someone's asking me a quick question. When is the webinar on tax coming up? Well, the budget just came out on the 27th, basically like 4 or 5 days ago. So we are planning a new tax webinar fairly soon. The current webinar done in November of 2017 is actually completely up to date. So the most recent webinar done in November of 2017 is completely up to date. Alrighty. So, and before we part for this wonderful day, I just want to say, I just want to kind of show something on my screen now. A lot of people have been asking me which elective they should take, and I want to take this opportunity to share this kind of graph with you. So these are figures for Yeah, actually, let me show you how you can kind of maybe even zoom in here a little bit. I'm going to try to, let me do this. So as you can see here, what we're really working with here is 2015 data on the left. Okay, so I'm on the left of your screen now. You should see 2015 data. And on the right of your screen, you should see 2016 data. So what I've done is I've tried to look at what percentage of people received competence or competence with distinction on individual assessment opportunities. And this is set up in a really nice graph. By the way, 2017 results are not available yet. So for anyone who's asking, what elective do I take? Here's more information for your decision. So 58% compared to 54%, 2015 versus 2016, passed audit and assurance as their elective on the CFE. Finance remained pretty stable, 57 to 58%. Performance management, 51, jumped to 58%. And tax remains at about 52%. Now, why am I sharing this data with you? What I'd like to do is actually upload this and make it available for you. Now, the reason why you should care is you should go through not just the percentages and not just the averages. What you should go ahead and go through are the individual other figures. Like, for example, what percentage of people got C in, say, the calculation of ABI versus salary or dividends, right? So what percentage of people got, a C in, say, the overall evaluation work, right? 61% did that. So if you're considering one specific assessment opportunity, look at how the assessment opportunities have been tested. Look at the subjects that have been tested and look at how the average person performed in that specific role. And then think back to yourself and say, do I know these areas? How comfortable do I feel with my own, performance? And how comfortable do I feel in general about these areas? And, at that point, I think you'll have a more clear answer on which elective you may want to take. Okay. But in general, I want to say thanks for attending this webinar so far. I'm just going to kind of highlight that if anyone is currently not a registered PrepFormula student, or if you have any friends that are currently going through the process that you would like to refer to the program, we're trying to finally increase our prices. So there's kind of a quick price early bird special that's on currently, which includes ongoing weekly webinars from now all the way up until the 2018 CFE, generally twice a week, which you should be attending. Dedicated mentor who is a CPA marker for one-on-one coaching sessions and for case marking, a schedule for the CFE or each individual module that you take with us, objective format questions and multiple choice, along with a case database, summarized notes, and along with our pass guarantee with ongoing material access until you pass. Now, if you have any questions, please do let me know, and don't hesitate to contact me if you need any additional assistance. Here's my direct email and direct phone number. If you are a registered student at PrepFormula, you can download the slides from the webinar using the link provided. If you click back, you'll see the link. And if you're not a registered student, you can download the slides as well if you sign up for any package. Okay, so the slides are what I'm talking about, and I know these changes will be, essentially provided to you. In the meanwhile, I'm seeing a lot of people saying thanks. You're all very, very welcome, and I just wanted to make sure that you're all extremely comfortable with all these changes, and I didn't want any questions. These are so important, and there's so much stuff out there, and more importantly, I seem to be getting so many emails from these firms. And I don't know if this is you, but there's lots of people who are providing their own guides for IFRS 15, and when you read them, they're extremely complex and they're very difficult to apply. So I wanted to kind of basically provide my own spin on it. So none of this should be difficult, and a lot of this should be very straightforward for you to understand. If you don't understand something, please don't hesitate to contact me. Okay. This was a trial run, by the way. We actually had a lot of people who were repeatedly asking me to do a Saturday webinar. So we actually moved the webinar from Thursday over to Saturday to today, just to test and see whether we'll get more people who are participating. Please leave your comments, okay? It would be really helpful for me to understand, should we be doing more Saturday webinars, okay? Please leave your comments. Please let me know what you thought of the webinar. Was it useful? Was it not? What did you like about it? And, do you want more Saturday webinars, or do you want to stick to the Tuesday, Thursday setup? Okay, please let me know, right? Otherwise, you're all very welcome, and hope you enjoy the rest of your weekend. Thank you so much, and take care. Bye-bye.